So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey guys, welcome back to The Daily Call. And so this question came in from somebody who submitted a question online after we just got started and kind of launched this podcast. So very cool that you guys do that. And again, if you have questions or topics you want me to cover, head on over to optionalpha.com/ask. And that's the best way to kind of leave me a message. But the question was, Kirk, it looks like you prefer ETFs versus stocks. So the big question here is, should you trade ETFs or stocks? Now, I'll be totally open in saying, yes, I prefer ETFs over stocks given the choice. Given the choice meaning if we've got a market that all has implied volatility that's high, right, or all has low implied volatility, and nothing is really discernibly better or worse than the other, then yeah, of course I prefer ETFs over stocks. Now, the trade-off that you make in doing this is that with ETFs, we know that they're going to be less volatile. So does the market, right? So does everyone else. So option premiums on ETFs might be a little bit lower than option premiums on a stock, because a stock still has that risk that the company gets bought out, or that, the CEO, whatever, embezzles money and, drops. I mean, there's so many different risks in a stock that could change it in a single day or a couple sessions. Now, I just don't want to take that risk for my main portfolio. Now, that doesn't mean that we won't trade stocks. We do very often, but we prefer to trade stocks when implied volatility is a little bit higher. And so what I mean by that is, if we've got a market that, say, lots of our ETFs are, implied volatility rank of 40 to 50, right? We'll still trade those. They'll still make up, kind of our core positions. We won't overly allocate into those, but we'll have a good mix of those. But right now we're looking at a trade where Amazon and Apple have high implied volatility still after earnings. And so for us, that's good, right? We don't have an earnings event coming up on the horizon, so we made trades in those, right? We entered positions there because they've got high implied volatility. Now, they're not the only positions in our portfolio, and never should just stocks be the only positions in your portfolio, but they make up, a little subset of trades that we're making. So I think most of your trading should encompass a lot of ETFs. I think they're more liquid. I think you can get better diversity with ETFs than you can with stocks, but you don't want to shy away from some really, really good opportunities in stocks. Just be more picky about it. And I think that's really kind of the gist of it, is just be a little bit more picky about which stocks you choose. Don't choose, to trade Nike just because you want to trade Nike when it's got low implied volatility and option volume is really crappy, right? Skip it. Go over to an ETF that has much more liquidity, even though it might have, low volatility. It might generally be more stable for your portfolio, more consistent, steady growth in your account. So hopefully you guys enjoyed this. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from optionalpha.com.